Hello and welcome to the fourth episode of Meet East Capital. My name is Jacob Grapengiesser. I'm the CIO of East Capital. And today I have my colleague David Nicholls on the line and will give you the highlights of emerging and frontier markets during the first quarter. Overall, I think it was a decent quarter for emerging and frontier markets. We had developed markets up 9%, emerging markets up 2.4%, and frontier markets up 5.3%. But it was an excellent quarter in terms of our performance, or rather outperformance. Our frontier market strategy delivered a 9% alpha during the quarter, and our emerging market strategy delivered a 3.1% alpha. David, would you mind just sharing some further thoughts on what happened in the markets?
Yeah, sure. So if we look more at, firstly, at absolute returns, particularly in emerging markets, of course, the main driver was AI, as we saw in developed markets, and that's particularly true for Taiwan, which is 17% of the index, returned 14% in the quarter. So really driving the very large majority actually of the absolute returns. And I think it's interesting just to note, you know, the largest actually stock in emerging markets, and also one of a large overweight in our fund, is TSMC, which produces all of the advanced AI chips for NVIDIA. They had a really good earnings call, TSMC, in the quarter. AI, obviously major growth area, high teens percentage of revenue by 2027, which is a huge increase compared to what consensus was expecting, and sees really that demand is outpacing capacity planning for the really long foreseeable future. Now, we think the stock remains quite attractively valued at 16 times PE for 2025, compared to 29 times PE for NVIDIA, despite sort of comparable earnings growth of 25 to 28%. But of course, you know, AI and these sort of themes is very much not just TSMC, the one stock. And actually, I think one of our main pieces of work during the quarter was taking a really deep dive into the whole AI value chain to really identify companies that may be a bit under the radar of sort of global investors, but also benefiting from this very strong demand. And actually, one of the key areas we found is transformers, which are obviously needed to supply power to these AI data centers, as well as for renewable projects, actually. And it's an incredibly tight market. You know, prices have gone up about 70% since 2020. Waiting lists are up to 4 years, so very high visibility. And as an example, we added one company in Taiwan last month. It's already up 50% compared to where we added, obviously generating a nice amount of alpha for us. But elsewhere, of course, the focus remains on China. It's still 25% of the emerging markets benchmark. And Jacob, you're based there. So what are your thoughts on China at the moment?
Yeah, I think we're seeing some small signs of improvement. It's everything from my local lunch restaurant that was half a year ago just empty, and now it's almost full. Obviously, this is very anecdotal, but you can see that the market has recovered 13% from the low since February. Many of our stocks are actually up 20-30% since then. So probably that means that at least some other investors are noticing them. I attended a lunch actually in Beijing with probably the CEO of the most famous American investment banks. It was me and 3 local CIOs. Those local CEOs were managing slightly more money than I am. I think the smallest guy around the table had $300 billion. But I think only the fact that the CEO actually came to Beijing, obviously to meet the key policymakers, tells you something about the importance, and that China is again back on the radar screen, right? So if you look on more concrete data, inflation is 0.3%. So I think that at least it's inflation and not deflation, but it's obviously not a great number, right? So demand is not really picking up. But for certain sectors, like copper demand, for example, was up 25% on a year-on-year basis. So you see, like, you know, small bits and pieces of evidence that things are picking up. I think the big question is, of course, the real estate market, and we are not seeing any recovery in the Chinese real estate market. Is probably going to have another 20-30% kind of less new starts this year compared to last year. So another kind of difficult year for Chinese real estate. But what we are doing is that we are looking on pockets of growth, or sectors that are a bit isolated from the general economy. For example, education. I think the last thing that Chinese parents would save on would be education for their kids. So we bought an education company. It's growing 10-15% per year. Not spectacular, but it's trading at 4 times earnings with a 10% dividend yield. So I think that the case is more the valuation here, right? Maybe this should be double or even triple that valuation. All right, David, but why don't you mention a few more details on our companies in China?
Yeah, well, I think one of the other really major themes in China that we see as really underappreciated by investors is this really strong pivot to focusing on shareholder returns. Because if you look at the last decade, the focus really from most Chinese companies has been about raising equity and equity placements and issuances all the time, and it's been incredibly dilutive for existing shareholders. And actually, you've seen EPS drop over the last 10 years, largely because of that. Actually, in the last sort of year or so, or even 6 months, you've seen this enormous focus on actually returning capital to shareholders. And one of the most high-profile examples, for example, is Alibaba, which bought back 5 billion of stock in Q1 2024, and that's around an 11% yield on an annualized basis. But of course, some of our smaller companies, sort of Hong Kong listed names that are even more sort of bombed out than Alibaba, yielding 10 to 20% if you look at the combined dividend and buyback yield, which I think, and that's also one of our sort of key engagement themes when we're speaking to these companies. Can and should you be paying up more like your peers are? So yeah, I think that's something as well that adds a bit of an anchor and maybe a bit of upside for the Chinese market. But yeah, we also had a great trip to India, Jacob, in the quarter. What are your sort of thoughts in general on the market?
Yeah, so just to wrap it up on China, so I spent a lot of time meeting the Chinese companies. I think you're absolutely right, David, that some of the companies started to pay out, and I think they really cared. They asked me, like, "Oh, Jacob, what should we do?" And I said, just pay out all the money or buy back shares and cancel them, and they listen. But it doesn't go for all companies. So I think you need to be quite selective here, which is always our job, to find those companies that really care about shareholders. Because some of the companies, they actually don't pay out the cash. They sit on it, or they buy back shares and then they give those shares to the management, for example. So I think there are good and bad examples here. Yeah, so for India is a very different investment case compared to China. In India, it is really all about the long-term growth and effectively people getting a better life. So if the average income grows by 25%, which effectively is the case over 3-4 years, right? The amount of people, the share of the population that has above $15,000 annual income goes up 6 times. So it's a massive increase in the amount of people that can afford certain services like private healthcare. We even looked at wealth managers in India. Wealth managers not for the rich, but just for the middle class. David and I were in Mumbai recently, and you saw advertisements on buses, buy mutual funds. You wouldn't maybe necessarily expect that in India. So the growth story is great. You can really find this 25-30%. Annual growth for the next 10 years for many companies. The problem is that, of course, also, other investors and especially the local investors have discovered this. So if you look on the left here, the small cap index is up 150% since 2020. And I think there's a bit of bubble territory. I've never been to such a crowded and maybe messy conference as the one we went to in Mumbai. Many of the companies we met, there were sort of P 80 to 100 stocks. So yes, the growth case is there, but if something goes wrong, there's also very significant downside, right? If you buy something at P 100, and personally, I like to buy things at a low valuation, so that you can buy them and really get this sort of value uptick, and maybe the multiple should increase and not decrease over time. So David, can we find something interesting in India?
Yeah, well, I mean, we certainly think so, but I think that as you were saying, that the conviction needs to be really high. So as an example, one of my favorite companies is Grapengiesser India. It's one of the largest recycling companies in the country, currently focused mostly on lead battery recycling, basically. So lead from cars, lead batteries from cars and lorries. But because of that conviction, I actually spent the full day visiting their production facilities, meeting with management. And yeah, conviction definitely remains very strong. You know, I think the first thing to mention, this is not a 100 PE company. This is 16 times PE for next year, while offering this sort of 20 to 30% earnings growth solidly, really as far as you can sort of see. But I think one of the reasons we really like the recycling sector as a whole is, and something I was exploring a lot in the meetings, is very high barriers to entry. You know, it surprisingly so, actually, largely because it's very difficult to source the scrap for recycling, difficult to get government permits, and also very difficult to get approvals from the companies to buy back your scrap to reuse in the batteries and things like that. So no, absolutely, we can find these names, but you've got to be prepared to really sort of go on the ground and do your homework. Yeah, which is a fascinating trip. But yeah, Jacob, you're also in Indonesia, I think. What were your thoughts on that?
Yeah, right. It was actually my first time in Indonesia, and I was, I think, one of the very few foreign investors at the local conference. I had a front row seat, and the new president-elect, Prabowo Subianto, was there. You can see a picture of him here. He's actually an ex-general, but people say he's a so-called good guy, and he has promised to turn GDP growth from the current 5% to 8%, so along the lines of India. And you know, you can use the same investment thesis effectively in Indonesia as you can in India. Currently, we only have one holding in Indonesia. It's the leading chain of sport goods stores. It's called Mapaktif. You can see me there. I bought a pair of new shoes. Actually, it's Asics. They are slightly cheaper in Indonesia than other parts of the world. So I bought them in their store. The stock is actually up close to 300% over 2 years. So we're a happy shareholder. Having said that, though, it's no longer that cheap, perhaps, the company. So great company, but valuation-wise getting a little bit pricey. We're thinking about what to do there. Yeah. And if you go to the smaller markets, perhaps, David, on the frontier side, what's happening there?
Yeah, so I mean, I think as you mentioned at the start, definitely a good quarter in general for frontier markets, with 5% performance, and really continuation of the themes we've seen over 2023. So sort of strength in Eastern Europe, Central Asia, these sort of underappreciated but just solid, reasonably valued companies, sort of producing sort of quite consistent growth with good ROEs, good earning visibility. But I think what was the most interesting sort of development in the quarter is to see some of these more sort of challenged markets taking some necessary but quite painful steps to correct the imbalances in their economies, which will significantly improve their investability. And probably investors are aware, you know, countries like Egypt and Nigeria underwent huge currency devaluations, big interest rate rises, which is again painful. And actually we had very limited exposure to these countries, so it doesn't necessarily affect us from a relative performance. But what it does mean is that these countries are now coming back on the radar and offer quite interesting investment prospects for investors like us. So definitely something we're looking into closely. But yeah, Jacob, just to wrap up, maybe how do you see the markets developing in Q2 and beyond?
Yeah, so I think we'll see. Markets had a pretty good run. I'm not sure it's going to continue, but I probably think that investor interest for China is picking up. It's everything from anecdotal to, you know, some of my big clients calling and asking sort of what's going on, should we invest, etc. So clearly interest is there. I think it's a bit like Ray Dalio said, that, you know, the time to invest is when everyone hates the market. So I think that's probably where we are now. But as I said, I think in a quarter from now, I'll probably have much more evidence, both in terms of tangible data, but also investors that have deployed money into China. So I'm quite optimistic that that's going to happen. Yeah, so outside of China, you're seeing also the AI story playing out. We don't necessarily want to buy, you know, the P100 stocks. There are some of them, for example, in Taiwan, but we try to be a bit smart, and as David mentioned, buy, for example, the transformer companies, etc., to get the sort of indirect exposure to this, but at a much lower valuation. So yeah, we'll see. But clearly, focus will be on China, and we have done relatively large changes in the portfolio. So we also hope, of course, that they will start to play out and continue to deliver very good alpha for us. All right. So thanks everyone for listening.
you.